Hello and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We got another CPI report that points to celebratory rate cuts, potentially in September. What we saw today was basically inflation coming down, but not too quickly. And that's exactly what the Fed wants to see, especially as weakness creeps up in the job market.
What you've had over the last couple of years is just this record demand, record prices, and basically I see that as leveling off. My fair value on Delta is $39, kind of coming in closer to where I thought it would be. The quarter really didn't surprise me. The key story really is a little bit of price softening.
This is the 8th price increase that we've seen on membership in the last 40 years. And over that time frame, they've seen no measurable significant impact on membership renewal rates and membership behavior. So we think this is incrementality to Costco's bottom line and should help drive further earnings growth ahead.
We got 1 hour to go until the market close, so we're here to take a look at the major averages as we see the ripple effect happening, Josh, from the consumer price index coming in better than estimated, showing the disinflationary trend is intact. So that's changing all kinds of expectations, or in some cases reinforcing expectations for what the Fed's going to do with rate cuts. Right now, it only means a tiny gain in the Dow, up just about 36 points, 0.1%, but we've got a big rotation today. And this is something that you and I have been talking about because basically investors are getting out of tech and they're getting into some other areas. The S&P down 0.75%, and the Nasdaq's the worst performer today, and it stems from what's going on in the rates market, where we see a big drop in rates.
Yeah, I think it is, Julie, one of the more interesting market days I think we have seen in a while, and it is that rotation in the market that has people talking. The way that big tech is not working today. They're in the red. But the way, low, as you said at the same time, lower interest rates. Right. So not surprising. The moves we're seeing in some of those rate-sensitive areas today.
Yes.
Home builders, REITs,
so
utilities,
let's
all
take a
have
look
been
at the
working.
sectors. Let's take a look at the sectors here because we see that, right? REITs is right next to you. XLRE up there in the left-hand corner, up 2.4%. Utilities, also rate-sensitive. Materials, industrials, all of those doing well. And tech is where the money is flowing out of. You can see that in the Nasdaq 100 as well. Again, you're on the more extreme side of the chart today. It looks like both to the good and to the bad. I mean, Nvidia down 4% today. So
I mean, you look at big tech. We talk about it so much. I mean, you could pull back the chart, and these names have had such tremendous runs. Maybe it wouldn't be too surprising if they saw the data today, and maybe some are booking profits, redeploying that elsewhere. And one place they're putting it that we haven't talked about yet, we were talking off camera about this, is the move in small caps today.
Yeah, let's get back and look at that.
Which is costing a lot of people's attention too.
Yeah, most definitely. I was looking at the equal weight, which is up 1.1%, but the Russell 2000 of small caps is just ripping higher, 3.3%.
Right.
We haven't seen that kind of outperformance from small caps in a while now.
We've talked to smart strategists who've been, live television, just go with it. We've talked to a lot smart strategists who've been talking about, been kind of pounding the table for those kind of pint-sized names. You don't want to, it's interesting. I guess the question is, you don't want to make too much of a one-day move. When big tech slips and you see kind of people bidding up the pint-size names, and I guess the bigger question is, you're trying to figure out, is it a one-day move, or is this rotation we're talking about here, is this going to be something bigger, something broader?
Yes, we will see, because this has not been the case thus far this year.
No, it has not.
Definitely.
All right, let's talk to someone who maybe has an answer for us.
Yes.
All right. Today's sell-off, let's welcome in Kevin Mon, the Chief Investment Officer at Hennian and Walsh. Kevin, it is good to see you. So listen, let's start there. As you heard us, Kevin, we're trying to, this stock rotation we're seeing together has a lot of people talking, and we're trying to figure out if what you see here today, big tech slipping, but listen, those interest rate sensitive sectors, they're working, Kevin, small caps cashing a bid. You think it's a one-day move, or no, this is something bigger, it's broader, it's going to stick?
Yeah, Josh, I think the rotation out of large cap technology stocks may have begun today. And that rotation is going to be led by cuts in interest rates in addition to earnings growth beyond the Magnificent Seven technology stocks. And to put that into perspective, let's remember that over the course of the last 12 months, 83% of the earnings growth in the S&P 500 has been driven by the Magnificent Seven technology stocks. We also know that through the first 2 quarters of this year, the market was up by 15%. Pull out the Mag 7, it's only up 4%. Now, while that's an average year for the markets, it certainly doesn't sound as good as up 15%. So the market needs to see earnings growth from those other 493 stocks this quarter. And the good news is, according to FactSet, it's forecasted that earnings growth will reach around 8.8% in the second quarter. If that holds true, that's the best quarter year-over-year earnings growth since the first quarter of 2022.
The irony is, I couldn't help but thinking this, you know, if we 2 years ago had gotten a day when rates were dropping, when the yields were dropping, tech would have been up, right? So there's been this big sort of shift that tech is now a haven, which is sort of ironic. But I do wonder, as rates do start to come down, if the Fed does start cutting, will those companies also benefit? Will you continue to see this rotation, or will it just be a buy everything kind of market?
Yeah, the tech trade isn't dead by any means. And in fact, I think there's going to be years more of growth opportunities related to the AI ecosystem. But what areas of the market really haven't taken part in this rally that started in the beginning part of last year? How about areas like industrials, aerospace and defense, consumer staples, healthcare, and even utilities? No one's looked at utilities for the better part of the last 3 years as rates have risen. Guess what happens as rates come down? All of a sudden, that utility that pays 4.5%, 5% looks pretty attractive again. And it's also another way to play the AI game, remembering that these data centers that power all these massive algorithms in AI, they rely upon utilities that supply the electricity solutions that they need. So I think there's another good way to play in those areas of the market that still are trading at attractive valuations, pay good dividends, can weather an economic slowdown, and will offer more upside, perhaps even more so than what we've seen from technology already. Not that you should trade out of your technology stocks altogether, but perhaps take some of your gains and redeploy to other areas of the market.
Yeah, I mean, utilities is interesting, Kevin, because we've got strategists come on, and they like utilities because they feel like you've got a little bit of offense and defense in that sector.
Also,
you heard Julie and I talking about small caps today too, which is interesting. I mean, there's sort of a big tech slipping a bit, but small caps catching a bid. Do you tell your clients, yes, you want to be in small caps here?
I believe you want to stay diversified. And a lot of clients out there right now who saw that through the first 2 quarters of this year, the market was up by over 15%. Last year, the market was up over 26%. And they were parked really in short-term CDs and treasuries earning 5.25% relatively risk-free. Smart way to play. But guess what? Add those two together, you've missed out on a pretty significant upside that's taken place in the stock market. My fear right now, Josh, those investors come off the sidelines. They look to move into areas of the market like large cap technology. They're going to get in at the highs, and they should consider being more diversified. Look to small cap, look to international, look to some of those other sectors that I mentioned as well. Have your allocations to large cap technology include the Max 7, but consider equal weighting as opposed to being market cap weighting.
I want to circle back to the earnings theme, because you and many others have pointed out that other 493 theme, that they're going to start to see earnings climb. Well, we got a trio of companies today in the form of Delta, Pepsi, and Conagra. And all of them, first of all, disappointed. But secondly, the theme seemed to be that the consumer is weakening. Not necessarily even just the lower income consumer, which had been the sort of conventional wisdom.
Yes.
How much of a concern is that?
It's been a concern of mine for a while, but we have to remember this is an intended consequence of all the rate hikes that the Federal Reserve has done over the course of the past, let's call it year and 3 quarters. 5 and 125 basis point higher on the short end of the curve. They're trying to cut demand by hurting the consumer. Here's the catch though. They forecasted unemployment to hit 4.1% by the end of this year. We're there already. They didn't forecast first quarter GDP growth slowing to 1.3%. I believe Chair Powell and the FOMC is now concerned that this economic slowdown may be progressing too quickly, and while inflation is moderating. That's why I think 2 interest rate cuts are back on the table again, because we have an over-leveraged U.S. consumer, over $1 trillion in credit card debts, early delinquencies on those credit card balances, on auto loan balances are increasing, and also the federal government is also over-leveraged. You look at our debt to GDP ratio. So interest rates need to come down. And I think those earnings reports that we saw earlier today, I'll just focus on Pepsi to start. So my household, the Mon household, is kind of split there. My daughters and my wife like Diet Coke, I like Diet Pepsi, but we all have a mutual admiration for Fritos.
You all get along.
We all like Fritos, right? Who doesn't like the great American corn chip? But what we saw from Pepsi today is that they missed on earnings. No, they beat on earnings actually, but they missed on revenues. And they also forecasted weaker revenues going forward because of weakness in the consumer. Boy, isn't that a telltale sign?
Yeah.
Right? Weakness in the consumer. That's why I think the Federal Reserve is going to have to step in. I'm not going to play the guessing game. Will it be September before the election? But there are still 2 meetings after the presidential election. 1, 2 days after the presidential election. They still could cut 2 times this year. And if in fact that's the case, look for those beaten up areas of the markets to actually start to really perform.
Given your views of the consumer, and you're right, I mean, Kevin, we look at kind of the PepsiCo commentary on the consumer today. It was, talking about persistent inflationary pressures and higher borrowing costs and tighter household financial conditions, right? Does that inform how you want to put money to work in the market then? I mean, do you want to avoid middle income, low income, just stick to high income? How do you think about it?
I think you still want to build a diversified portfolio consistent with your risk tolerance. We often get the questions from our clients, the market is racing higher, I want to be more aggressive. Oh no, the market's trading off, let me be more conservative. That shouldn't be the case. You should build a portfolio consistent with your risk tolerance, what your goals and objectives are, and what your investment time frame is. Do you make tactical adjustments? Of course you do. In fact, we're equal weighted in terms of our exposure right now to those high growth technology stocks. We've added some exposure to artificial intelligence areas. We love data centers in this environment. We think that's the hidden gem within the AI ecosystem. We have money overseas. No one's talking about international stocks right now, but if you look at the EFI index, MSCI EFI, it's up over 8% during the first half this year. Emerging markets almost up 10%. So build a diversified portfolio, resist the temptation to try and time the market, and stay invested in the market.
Lots of ideas in there. I want to leave you on this, which is an election question, which I'm sure, we're going to be talking about this for the next several months, if not longer. Obviously, there's a lot of debate right now about whether President Biden should step aside as the Democratic candidate. There hasn't been really any market reaction to that debate. What do you think the reason is for that, and when do you think we might start to see some of that being felt more?
I believe the market is more focused right now on when that first interest rate cut is going to take hold, and if in fact this economic slowdown is going to dip into a recessionary territory. If markets are actually pricing in what's happened historically, remember that political parties have an impact on certain areas of the market, but generally not the market as a whole. In fact, history tells us that a divided government generally bodes best for stock market performance. That's because no major new rules or legislation or regulations get passed. I think that's what markets believe is going to happen coming out of this particular election as well. What we're talking to our clients about is build your portfolio consistent with the opportunities that we believe are in the economy right now. And once we know the outcomes of that election, then you can overweight or underweight certain sectors based upon the policies of those that are in power at that point in time. But don't let it sway all of your decisions. Don't sit on the sidelines waiting for the outcome of the political elections, because we know that trying to time the market is an exercise in futility. If you look back to 1990, if you just missed out on the 10 best days in the market, your returns would have been cut in half. I don't know when those 10 best days are. You don't know when those best 10 days are. But I can assure you, if you're not in the market on those 10 days, you're not going to participate.
Look at the election in 2016, the market reaction that then was reversed. So
that was reversed. That's
you never know. All right. Thanks a lot.
My
Appreciate
pleasure.
it. Good to see you, Kevin.
You too.
We're just getting started here on market domination. Coming up, shares of Tesla giving back some of the recent gains on news that the EV maker is delaying its planned robotaxi unveiling to October. We'll talk about that on the other side. Plus, PepsiCo sounding the alarm on consumer spending in its most recent quarter. We're looking at how to navigate in the big picture in today's investor playbook.
And one strategist is raising his year-end S&P 500 forecast to 5,800. We're going to be chatting the roaring 2020s with Ed Yardeni in the 4 p.m. hour. Stay tuned. More market domination still to come.
Let's get to some of the trending tickers today on Yahoo Finance. First up, we've got Tesla. Unfortunately, all good things must come to an end. At least if you're a Tesla shareholder, you see it as a good thing. That includes Tesla's 11-day rally. Here with more, Yahoo Finance's Pras Subramanian. And Pras, the shares were up about 44% in that 11 days. But today, the stock is falling.
Yeah, the big reason why is this Bloomberg report about the robotaxi revealed that was scheduled for August 8th, going to get pushed back about 2 months into October, perhaps. That's the reporting that Bloomberg is saying that basically the reason why is that Tesla needs more time to build the prototypes for the robotaxi. In addition to the fact that there might be some rework of the design. Some people, I guess, aren't happy with how they look, the actual robotaxis right now. So that deadline has been communicated internally according to their sources. The questions that I have are, does this mean the robotaxis aren't ready for prime time, or is the software not ready for prime time? You have competitors that are already testing out their robotaxis in sort of geofenced areas. Did Musk jump the gun on when he said, hey, August 8th is going to be our reveal date? Imagine he had done that. Imagine this date change had happened before his pay package was approved, right? Things like that are. I mean, I'm not saying this is a they knew before, but it's just interesting to think that. Hey, would he have been able to get that pay package? Just stuff like that.
I mean, I think investors are kind of used to him shifting dates for things, so maybe that's part of it too.
And he hasn't said anything on X yet, right?
I haven't seen anything yet.
No comment yet.
But Julie, you're right. The Cybertruck pushback, Model Y, Model 3 were all pushback. Like it's just part of their whole aggressive timelines, and they kind of adjust that on the fly.
Then separately, perhaps we got this new report today. Tesla's market share maybe not what we once thought or what it used to be.
Well, yeah, according to Cox, they do this sort of EV kind of report. They do all kinds of sales reports on a quarterly basis, and they found that for the first time that they've been tracking this, that Tesla's market share of the U.S. total pie is below 50% for the first time in Q2, around 49.7%. It's to be expected as more competitors come online, more offerings are out on the market, but it's still kind of a milestone or sort of a key sort of threshold that was sort of breached. There, Tesla still sells the most vehicles, but
I'm just curious, did they say in that report who's taken the share?
Yeah, so share is sort of kind of coming down to Ford, Kia, Hyundai, even BMW. On the higher end, the more vehicles that are out there, competitive pricing, maybe better products even. So consumers have a lot more choice. You don't have to go Tesla now if you want an EV that's reliable and has good range. And of course, they have the nice big charging networks. That's a big deal there too. But top models too, I want to get into that too. The Cadillac Lyriq really doing well this year. GM ramping up their Cadillac Lyriq production. People are buying that. You're seeing a lot more of those with livery and rideshare drivers too. Hyundai Ioniq, I mentioned Hyundai, Kia's EV9, EV6. The Toyota BZ4X actually kind of selling well, and same with the Nissan Ariya. Good cars, but they're selling at discounts. That's the only issue is can you make money off
I have to say, anecdotally, I've seen an awful lot of Hyundai. Is it Ioniq 5 and Ioniq 6? Yeah. Yes, I've seen those, and I've seen a lot more Kias as well. So
for sure.
There is one more EV-related story that we're watching today. Its stock is trending even above that of Tesla's on the Yahoo Finance platform, and that is QuantumScape, the battery company. The share's up, more than 25% after they signed a new agreement with Volkswagen. This has to do with solid-state batteries, which I admit I do not fully understand.
Right.
What can you tell us about this whole thing?
So QuantumScape signed a deal with PowerCo, which is VW's sort of not really a joint venture, but it's a wholly controlled company that does all their battery producing. And so they were already an investor in QuantumScape, one of their top shareholders. Now they kind of inked a deal to have a non-exclusive license to build these solid-state batteries up to 1 million EVs a year, according to the actual deal. Basically, these solid-state batteries they're lighter, they hold more power, they can discharge more power, just overall more efficient. Toyota's working on these that can make their cars potentially go up to 600 miles in a single charge. So it's kind of a big deal. It's a really kind of game-changing moment for EVs if they can actually make these at a cost-efficient way. That's the problem. Low yield rates. They cost a lot of money to make. The technology is still very nascent. It's going to be years away. But when they do, it should be a big deal.
All right, Pras, we'll be watching. Thank you, my friend. Appreciate it. Moving on, another trending ticker we've got our eyes on here is Delta. Check that one out. That stock tumbling Thursday after the carrier reported second quarter profit that missed estimates despite record revenue for the period, pulling down other airline stocks with it. Despite this, Delta CEO Ed Bastian told Yahoo Finance's morning brief the state of the consumer is strong.
Our consumer is very healthy. Our consumer tends to be a bit more affluent. Our consumer tends to have more discretionary wealth and purchasing capability. Our consumers tell us that one of their top purchase drivers for their wealth, their funds, are to continue to travel. So our consumers are driving the experience economy, and whether it's traveling to Europe to see a Taylor Swift concert or going to see friends another part of the country, that's driving a tremendous amount of our stability.
And joining us with more now is Yahoo Finance's very own Brad Smith. I stumbled over that.
Most common last name in America, my man.
I'm so excited to have you on the program. That's the problem. So you spoke to Delta CEO.
Yes.
What were your big takeaways?
Yeah, a few big takeaways here. And, we talked about everything from the state of the consumer all the way to this phenomena that some people may have heard of, where people are abstaining from any type of entertainment on their flights. The colloquial term that they're using is on Urban Dictionary. I won't say it here, but all these things considered, focusing in on the consumer right now. This is a very affluent consumer that the CEO continues to talk about, and how they're engaging with that core customer, continuing to remain healthy, as we were discussing and as you heard in a piece of that clip here. And one of the huge things that he said to me is that our consumers are driving the experience economy, he said. And as you heard there, of course, Taylor Swift going to be happy that she's been summoned into the chat for yet another earnings season again here. But it's a shift internationally here too that I would also point out, because a lot of the domestic kind of pushback that we've seen, that's showing up in some of the CPI prints, but it's really more so where you're seeing some rotation on the international routes that customers are flying as well, going more to the LATAM routes versus what we had seen last year into some of the European or overseas routes as well. This is also a company that just netted out a new deal with Riyadh Air, an international airline that hasn't even started up yet. That's not going to start flying until 2025. That's going to give them access into Saudi Arabia. That's also expected to give them a fair deal of profitability, but that's not going to be really added into these numbers for the next few years here. So ultimately, the investors right now are going to be taking away two things from this. They're going to be taking away that there's deceleration on the growth side, and they're going to be looking at some of the forecasts right now, like we did see come through, where they're projecting this range for the next quarter of about $1.70 to the top end of the range, $2. You compare that to the same period last year, that's actually down a couple cents.
Yeah, I mean, and the growth is pulling back at the same time the costs are going up. Labor costs for Delta are going up. They signed a new pilot's contract. There's other costs that are rising as well. And, Delta is viewed by many investors as best in class.
Yes.
So if Delta isn't doing well, then that maybe doesn't portend well for the rest of the airlines, and many of those stocks were falling today too.
Yeah, that's spot on. And one of the other things that he actually pointed out within our chat that I think we're going to have to hear from a lot of the other airlines too, to see how they address this, is really the aircraft and the fleet that they're operating right now. One thing that he told me on the call was that with regard to maintenance for the existing aircraft that are in their fleet, some of that maintenance operation is stretched. And they're seeing a lot of that aircraft, even though they're expecting to take about 40 to 50 Airbus deliveries this year, they're seeing some of the others hitting maturity or getting closer to maturity, and this could spell out a several years type of problem for the entire industry, not just Delta here. And they are the least exposed to some of the issues that Boeing has seen, especially with the 737 MAX here.
All right, Bradley, thanks for joining us. Appreciate it.
Anytime.
Some good news for consumers. Headline inflation falling in June for the first time since 2020, and overall prices fell from May to June by 0.1%. And joining us now is Simona Makuta, State Street Global Advisors Chief Economist. Simona, it is good to see you. So let's get right to that big economic data point of the day, Simona. CPI, inflation moderating. What did you make of that print, Simona? And do you think at this point is a September cut locked in?
It was good, first of all, to get good inflation data for a change. I mean, we got a good one last month. Second in a row is very reassuring that what we experienced early in the year is not a new, uptrend. I think September is definitely a good time to start. In fact, I would have argued even July would have been a good time to start easing and calibrating interest rates lower. But I think right now we are looking at September, and I heard earlier in the program one of your guests saying, 2 cuts for the year. I think we should keep the possibility open that there might be even more than 2.
Interesting, Simone. I want to ask you, though, a lot has been made of how economists and maybe the Federal Reserve as well sort of got burned last year. In other words, there was a trend of disinflation initially at the beginning of the year that then reversed in the second half of the year. And that phenomenon has been used to explain why the Fed has been reluctant to begin its rate cutting cycle. How can we be confident that isn't going to happen again this year?
Well, I think the economy as a whole is in a very, very different place, and especially the labor market is in a very, very different place. Already, you guys had commented earlier in the program, feedback from companies that they are seeing the consumer become more cost conscious, making some choices, opting for lower end products in some cases. That would not happen if the consumer finances were as strong as they were a year or a year and a half ago, but they are not. And so increasingly, as excess savings have been depleted, the consumer as a whole, and I'm not talking about the high income and the top end consumer who still have a lot of wealth to draw down from, but the average person becomes much more dependent on the state of labor income. So on the whole, you're looking real personal disposable income growing just 1% year on year for the last few months. You become much more vulnerable to a downturn in the labor market. So here is what's different from a year ago. The downside risks to the consumer health actually are more prominent now. And in that environment, it's very hard to imagine some kind of demand reacceleration that drives back inflation.
Simona, some economists seem a bit cautious about those rate cuts. And they make different arguments, as you know. One argument I hear, though, is they'll say, if you look at the stock market and how that's been in rally mode, Simona, and that just means they say financial conditions getting easier, and do you really want to kind of throw more fuel on that fire? How do you respond to that?
I would say this question of how tight our interest rates has been a topic of heated debate for many months, right? So you have to look at it from different angles. One of it is the typical financial conditions index that takes into account market performance. That tells you things are fine. In fact, maybe not tight enough. But you cannot just stop there. You have to look at what in the real economy are consumers and businesses experiences as borrowing costs. And there, I think, is why you are starting to see considerable pain in terms of credit card delinquencies, auto delinquencies. Borrowing costs are high. So if you don't need to borrow, who cares, right? If you're locked in a 3% mortgage, who cares? But how about the other consumers who are not, and the people who do need to borrow, and the businesses that do need to borrow? So I think the overall tightness of rates and financial conditions, they are tighter than what some of these indicators that look primarily to stress, become only tight or show tightness when there is stress. It's not as easy and lax as those.
And Simona, what do you think the risk is that the labor market starts to turn a little bit more quickly for the worst as the Fed sort of, I guess, tarries and delays in its interest rate cuts?
So I think the good news is we still are in a very good place with the economy. We've seen a downshift in growth. We've seen a little erosion in the labor market, but nothing dramatic. So the Fed still has a little bit of room to maneuver and perhaps to wait a couple of more months before they begin calibrating rates. And we are not talking about dramatic cuts, right? We are just talking about, let's look where inflation is and whether a 5.5 Fed funds rate still is necessary given the direction of travel. So I'm not worried near-term things unraveling, but I think the balance of risk, as Chair Powell has actually acknowledged, and many on the FOMC have acknowledged, has shifted, and risks are more balanced. So we need to really think of the dual mandate as truly being dual again, and the labor market now matters as much as inflation. So not a very worrisome picture near term, but something that you need to be mindful of, that perhaps things are not quite as robust as you thought maybe even 2-3 months ago.
Simona, thanks so much for joining us today. We appreciate it.
Pleasure.
And coming up, a check-in on President Biden's economic track record. That's next on Market Domination.
President Biden on the verge of an economic milestone, even as he faces calls to end his re-election campaign. Here are the details. Yahoo Finance's Rick Newman. What's the milestone, Rick?
It looks as if Biden is going to get to the end of his first term without a recession. There has been no recession during the Biden years so far. If you look at the Bloomberg forecast, odds of a recession during the next 12 months are just 30%, according to economists they survey, and that's looking 12 months ahead. The odds of a recession have been much higher earlier in Biden's term. They went as high as 65%. And there were some economists a year or two ago saying it seemed almost certain that there was going to be a recession. There has not been a recession, and it looks like Biden is going to get to the finish line on this one. The question is, will it help Biden? And I guess the preliminary question is, will he even be the candidate going for re-election in November? That's a totally different story, and I think there's more news to come on that in the next week or two. But even if the candidate turns out to be Vice President Kamala Harris, she would, of course, be running to some extent on Biden's record. And I think she'll be able to say, look, we've had no recession on our watch. And by the way, inflation is cooling off at just the right time for the incumbent Democrats to be able to say, as people are making up their minds in September and October, look, the economy is going strong, job growth has been strong, and now inflation is basically receding. So there's a pretty good economic story here for the White House. But of course, there's a bigger story, which is whether Biden's going to be the nominee.
Biden's big press conference tonight, Rick. How much is that now? How much is that riding now? How big is this for Biden?
Well, I mean, it's becoming kind of absurd inside the Beltway. It's like this is a do or die moment for Biden. He's holding this press conference at the conclusion of this 3-day NATO summit. And there's actually important NATO news. I mean, you don't get to say that very often. There's important NATO news, but there is. Biden said this week that Ukraine is going to become a member of NATO, almost certainly, even though he didn't give a time frame for that. There's a new announcement. This is important, that the United States may now position some hypersonic missiles and other types of advanced weaponry in Germany, clearly aimed as a signal to Russia. Another new development is now it seems like Ukraine is going to be getting F-16 fighter jets by the end of this summer. I mean, this is all big stuff, but I think there might be 3 questions about that at this press conference, and then it's going to be all asking Biden, is he going to stay in the race? Why doesn't he drop out? Testing him whether he can remember, all these names of foreign leaders and stuff like this. And of course, everybody who's going to be watching, which is going to be a bigger audience than you'd ever get for a press conference about NATO, is just going to be watching. Does he fall on his face? Does he have a senior moment? Does he lose his train of thought? So there are a lot of people inside the Beltway who seem to think that it is inevitable that Biden is going to withdraw. And what we're looking at now is just the manner in which he does it and how clean the transition is to a new candidate. But we're not going to get that news tonight. We're just going to get Biden trying to prove his fitness once again on live TV.
And we'll see how that goes. Thanks a lot, Rick.
Hold your breath, everybody.
Well, the S&P 500 and Nasdaq are falling from records as investors rotate out of big tech. And this move lower coming after inflation cooled further in June. So what does this mean for tech winners like Nvidia and Microsoft? Corey Johnson, the Futurum Group Chief Market Strategist, is joining us now. Corey, it's great to see you as always. So one of the questions that Josh and I have been debating throughout the day, and then again at the top of the show, was whether this is just sort of a one-day blip as we see yields pull back a lot, or whether this is the beginning of a bigger rotation. What do you think?
Well, I think that there is some nervousness among investors who piled into some AI-related stocks, Nvidia chief among them, about the valuations, about the growth, about the change in the share price over a short period of time, and what might take the wind out of that sail. And indeed, might it be a change in inflation rate and maybe a reaction from a Fed that clearly wants to cut? I think that was certainly my takeaway from Jerome Powell this week, was that he wants to cut. And so when we get the inflation data we got today, maybe that just gives them just enough wiggle room to get there to start cutting. And does that change the underlying environment in which the AI stocks have risen, and therefore they don't rise as much and maybe a little comes off the table? On top of the Goldman Sachs note that I think has been really widely discussed and disseminated across Wall Street on an otherwise slow week, to think about, hey, if we spend $1 trillion in investment in AI, when are we going to get the $1 trillion back in a return in our businesses and our economy?
And Corey, it's funny that you bring up that Goldman Sachs note. I'm glad you did. I thought it was really thought-provoking.
I'm here to help.
And among other things, one of the data points that the note brings up is the number and percentage of firms in the U.S., and this includes firms of all sizes, that are using AI in their daily business or that are trying to. And it's not high, even not high among computing companies. It's a small number. So do you think that is a valid concern here, that we're putting all of this into AI, all this investment into AI, when is it going to bear some fruit?
Well, and we've done studies at Futurum Group polling corporate customers, talking about these very issues. And they say they want to spend and they intend to spend a lot more. But I think they're still figuring out what they're going to do with AI and where it can help their processes. But I think that, and the Goldman Sachs note, again, it is very thought-provoking. But I think one of the fallacies that the negative criticism in the note has is that the things that we do now with our computing will be the things that we do later with AI-driven computing. And I think that that's just wrong. I think it's hard for us to imagine the things that we'll be doing with AI. I was at SemiCon West this week, which is a big conference that is really about the manufacturing of semiconductors. And it pulls together a lot of the biggest and most interestingly, a lot of the small companies that do the work that makes semiconductors of all types. And there was a lot of discussion about AI, not driving demand, but about changing processes. How can we change how can we fix our plumbing, literal plumbing? How can we change our water usage by using the data that we get and processing it through AI in ways that weren't time efficient in the past? And how can we change our staff so they're fixing things before they break because AI tells us what's going to break in ways that we never would have done so because the calculations were just too time consuming to do. There are things that AI will let us do that we've never done before. And they might not be sexy things like writing your term papers on ChatGPT, which are easy to understand, but there'll be weird, different things that we've never done before. And I think that is where the revenues and the profits and indeed the GDP changes that the AI will wrought will come eventually. We just don't know what those are right now.
In the kind of near to intermediate term, though, Corey, I'm just curious. I mean, listen, you're talking to a lot of tech companies. You're going to tech conferences. Have you seen tech companies kind of roll out AI-enabled experiences that you thought, oh wow, that is new, cool, exciting. I have got to have that AI-enabled PC. I've got to have that an AI-enabled smartphone.
I think, when I think about semiconductors going back to the olden days when the coolest technology you could get was a portable calculator, electronic calculator in the 60s and 70s, right? That was driven often by a Texas Instruments chip. What was cool was the calculator. I didn't know what the math was going to be that was going to come out of it and what things were possible. I think the same is true right now. What we're going to see first are the tools, and later we're going to see the results. But I think that the change in the tools is what's so interesting. The fact that there's a Surface PC out there that's doing AI on device. The fact that I'm meeting with private companies. I just got off a meeting with a private company doing small language models, not large language models, doing modeling off of CPUs and even MPUs, not GPUs, right? Doing models, take out some acronyms there, doing AI processing of models on chips that cost a few $1,000s instead of $40,000, $50,000, $60,000. Those are the devices that are coming to market now, the startups that are getting funding right now. And I think we're going to see big companies like Microsoft and others, make investments in small companies that are doing small language models that will really change the nature of our understanding of the expense of creating an AI-powered world. And we're seeing that from the orders from the companies, some of those stocks that are selling off today, like Broadcom, right? Big sell-off from Broadcom today. And yet those are the companies that are really going to benefit from more nimble AI in the future.
Well, that's what I was going to ask you to sort of close out here, Corey, is all of the things that you're talking about, is it changing at all the way that you're thinking about where investments should, equity investors should be putting their money right now?
I think we really want to keep our eyes open to newly emerging companies that are doing interesting things that are different than massive investments like OpenAI spending billions of dollars at Microsoft with billions of dollars from Microsoft. We're going to see nimble, different kinds of players. We want to be wary of companies that are baloney, that are putting AI at the end of their names or claiming that their email marketing solutions of 10 years ago are now AI-empowered AI marketing solutions. There's a lot of garbage out there. We're going to see more of that than real solutions. But there will be real solutions. There will be names that we're not focused on right now. And maybe one of the things you see in the market right now, in the general stock market, you see an understanding that the big concentration of the move around the Magnificent Seven or whatever you want to call them might be wrong, and that while most S&P stocks have not benefited, they will benefit. So take a little bit off the table with the biggest companies and look for the smallest ones, because maybe that's where the opportunities will lie.
We will keep an eye on it with you. Corey Johnson, thanks so much. Good to see you.
With me.
Exactly.
It's good to see you guys too.
All right, coming up, value-conscious consumers are cutting back on snacking, according to PepsiCo, but don't write off the entire sector. We've got some top picks coming in consumer staples, particularly beverages. That's next on Market Domination.
Inflation is taking its toll. PepsiCo was sounding the alarm on consumer spending in its most recent quarter that saw sales volume for Frito-Lay in North America drop 4%. But there are still opportunities for investors in the wider consumer staples category, and we're looking at how you can navigate that space with the Yahoo Finance Playbook. Joining us now, Nick Modi, RBC Capital Markets Managing Director. Nick, it is good to see you. So you cover PepsiCo, so let's start there. I'm interested, Nick, to get your thoughts on the earnings report there, Nick, and also whether you thought there were any kind of read-throughs from that report for other names in your coverage universe, Nick.
Yeah, absolutely, Josh. So look, PepsiCo is an incredibly high-quality company. There's no question about it. You don't really have to worry about them delivering on earnings because I think they have a very good productivity pipeline and are very good at managing their P&L. But the top line was really the problem. And look, the snacking category has come under a lot of pressure for a variety of reasons. I think partly due to economic pressure, especially with low-income consumers that tend to over-index to this category. So I think that's partly what they're dealing with. This is not just a PepsiCo problem. This is a problem for the entire snacking industry. And quite frankly, the entire packaged food industry is under a lot of pressure. To your point about read-throughs, as we get through this earnings season, it's going to be very evident that packaged food companies are going to have to spend more money than they originally thought to really drive volume in this current environment.
And Nick, it's Julie here. When you say spend more money, do you also mean cut their prices for consumers?
Well, I think yes and no. I mean, I think what they're going to do right now is a lot of temporary promotions to really understand kind of how consumers are responding to the different price points, right? Now, there's not just price cuts. There's other alternatives. You can offer smaller pack sizes that are lower priced. You can offer innovation that might add a benefit, which consumers are willing to pay up for. So actually, instead of getting a price cut, you get slight price increase without actually raising the price itself. So there's a lot of things they can do. But yes, I do think promotional spend and marketing spend is going to ramp up in the back half of this year.
Nick, it was interesting to kind of read through PepsiCo management, how they talked about the consumer and they talked about persistent inflationary pressures, higher borrowing costs, tighter household financial conditions. Is that kind of your read on the consumer, Nick, just based on the companies you cover?
Yeah, absolutely. I mean, look, inflation, going up 30% for these products over the last few years takes its toll. But it's not just inflation in these categories. It's inflation in everything that consumers are doing, from electricity bills to your insurance bills to your mortgages. And so this is, we have to really understand, in the grand scheme of things, we are looking at an overall wallet issue, and consumer products is just a piece of that. But it's something that these companies have to contend with, given how much prices have gone up over the past 2 years.
And so let's get to what you do like, Nick, still within your coverage, and in particular, beverages. I find it really interesting that you highlight Constellation Brands as one of your pick, because that's one, as you point out in your most recent note, that investors really haven't believed in. And they maybe more broadly haven't believed in the beer story either. Why do you believe in it?
Yeah, I mean, look, we tend to take longer term approaches. This company has been able to deliver exactly what they've said in their beer business going back the last 10 years. All the work that we do with distributors, with retailers, suggests that there's still significant upside in Modelo Especial penetration across the country, and as well as Pacifico, and even Modelo Chelado, which has grown to be a pretty nice sized business for Constellation. I think this management team is doing all the right things. I think there's still significant upside. I still think high single digit revenue growth is the right trajectory for this company over the next several years. And I just don't think the valuation is reflecting it. Now, I can't control how investors view information, but from what I see, it looks like they're actually doing everything that they've said they're going to do, and they're outperforming all their peers, but they're trading at a discount.
And Nick, another name you like, and I think it's interesting, I want to hear the story, Monster Beverage. That stock has not been working, Nick, in the red this year, in the red over the last 12 months, but you see better times ahead. How come?
Yeah, I think, to me, Monster, we've had a buy on Monster for over 10 years straight, and the stock's gone up, 3.5x over that time frame. To me, Monster, the real thesis is that this is the next global mega brand, right? When you think about a Red Bull or a Coca-Cola, like the Monster brand has shown that it can transcend category and country. And so I think there's a lot of opportunity for this brand to grow internationally. Just think about this, Josh. There are more drinkers of energy drinks in China than people in the US. Okay. And they haven't even gained significant traction yet. That category is still building. India is another great example. So I think there's a lot of upside. But when I kind of think about where we are right now with the stock, given the pullback that it's had, I think that this is an opportune time to be buying the stock if you're a new investor or even an existing investor, because I do think the back half is going to improve through a series of investments. They're going to take a price increase in November, which I think will help the top line. And the international growth story continues to have momentum.
Nick, so good to have you on the show today. Thanks for taking the time to join. Appreciate it.
You bet.
And while wrapping up today's market domination, do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages and where they ended today. And as we've been talking about, there has been a big rotation over the course of the session today, driven by a drop in interest rates that was in turn triggered by a more benign CPI report, Consumer Price Index, this morning than had been anticipated. The Dow kind of moving sideways for a lot of the day here, up 32 points by the end of the session, up only about 0.1%. But the S&P saw a pretty substantial drop here of 0.9%, and the Nasdaq was off by 2% as we saw a rotation out of large cap technology and into more interest rate sensitive areas of the market. And also the sort of much awaited broadening is happening, at least today, with the S&P equal weight up while the S&P is down, and the Russell 2000 gaining quite a bit, 3.7%. As I said, a lot of it having to do with what's going on with yields here today. Big pullback in yields of 9 basis points to 4.19% on the 10-year. Jared?
Great stuff there, Julie. Love the dichotomy about the sector rotation we're seeing right now. I think if you were a portfolio manager and you had a little bit too much mega cap going into the day, you were able to rotate and get some small caps and some cyclical stuff there. So nice summary. Just want to go over some of the sectors. We saw real estate really pop after that report, but utilities is number 2 up there. Both of those very interest rate sensitive. So that big decline in bond yield to the lowest that we've seen in the 10-year in a couple months, that is front and center in this. And then you take a look at the 3 underperforming sectors here: tech, communication services, consumer discretionary. What are those? Those are the mega cap growth sectors. A lot of tech in there. Nasdaq 100 looks terrible today, but then you compare it to the Dow, and it's looking a little bit more palatable, at least the right side of your screen there, where you don't have those big tech names. Also noticing that JP Morgan, not a tech name, financial name, in the red ahead of its earnings tomorrow. Also want to check out our leaders, and here we saw home builders actually in the pole position. They are up 6%, XHB right there. This is a sector that rose to prominence with mega caps in 2023, then fell off a little bit. Its fortunes have been tied to interest rates, so today's kind of a relief valve there. And then you'll also see some action in TAN, which is a solar ETF, cannabis, regional banks. That's real interesting as we see the yield curve steepen. And then at the very bottom, we can see the MAG 7 ETF. That's MAGs down 4.5%. This is the worst day for the Magnificent 7 in about 1 year. In fact, you have to go back to the middle of July last year to find something that bad. Also taking it on the chin, and I'm going to show you a picture here. Semiconductors, Nvidia off 5.5% here. Taiwan Semi down 3%. I'm going to do a deep dive on some of these bigger moves with Josh in about 30 minutes here, so stay tuned for that. But I'm going to leave you with an upbeat note here. This is unprofitable tech. These are those ARC components. And on a day that you're seeing Tesla off 8%, you're seeing a lot of the other guys in the green here. So definitely not a bloodbath all around the horn, just really those big names.
All right, Jared, thank you. Appreciate it. S&P 500 pulling back from its record today as investors rotate out of tech. But our next guest is still bullish overall, raising his target for the S&P 500 to 5,800. And joining us now is Ed Yardeni. Yardeni, Research President. Dr. Ed, it is always good to have you on the show. So you raise your target, Ed, to 5,800. How come? Walk us through the reasons.
Well, I'm becoming increasingly convinced, as the market has, that the Fed is in fact going to start cutting interest rates. As you recall, at the beginning of the year, there was a lot of expectations that there might be 6 or 7 rate cuts. That never happened. I think this next rate cut that's expected in September is going to happen. And I think over the past couple of days, Fed Chair Jerome Powell kind of went out of his way to, hint and wink that if things keep going well on the inflation side, and they continue to be somewhat concerned about what's going on the labor market side, they're going to lower rates. And as we saw today, the market, as a result, started to broaden out to the SMID cap, to the small and mid cap stocks. So, but I think all in all, what I'm looking for is a very strong second quarter earnings season. We're about to get reports tomorrow. We get the banks. I think the banks are going to wind up reducing their loan loss provisions because there is no recession out there. So I think they're going to surprise us to the upside. And then I think a lot of companies that are not technology companies are going to tell us how they're using AI, to cut their costs and increase productivity. They're not going to necessarily say that it's making a huge change in their earnings outlook, but I think they're going to indicate that it could very well be an important development.
Ed, it's Julie here. The conventional wisdom has always been that if the Fed was cutting rates, not because there was some sort of overturning in the economy, but rather to bring us back to normal, that stocks could continue to rally in the face of that. Yeah. But are there any concerning signs for you? I mean, we are seeing a little bit of deterioration in the labor market. You have some companies today talking about consumer weakness, right? We've had a couple of guests today bring up credit card delinquencies ticking up. How concerned do investors need to be about those various elements?
Well, I think it's important to put it in the context of recent history. We did have this amazing event, not a happy one, which is the pandemic, and a lot of things really had some abnormal developments as a result of that, particularly the labor market. And I think what we're seeing is normalization. I think we're getting back to normal in the labor market, and I think we're getting back to normal with interest rates. We certainly have gotten back to normal with inflation. So when I put it all together, I'm not really that concerned about downsides for the economy. I'm not concerned that inflation is going to remain sticky. And I think, I'm going to listen to what Fed Powell said, and that's pretty strongly suggested that they're going to start cutting rates in September. That's all good for the bonds. It's all good for the stocks.
Ed, when it comes to the stock market, skeptics, they'll throw their yellow flags. They always do, right? And there's a couple here, and I want to get your take. They'll talk about, Ed, sentiment. They'll say too many bulls, and they'll also talk about valuation. This market just doesn't look cheap. How do you answer those two?
Well, when you get too many bulls, you are more vulnerable from a kind of a sentiment perspective to see some sort of correction. Because when you have too many bulls, there are just not enough bears to convert over to the bulls, and everybody presumably has bought. And if you get some bad news, and some of the weak bulls start to panic and get out, so it's conceivable that there could be a correction in the works here as a result of sentiment. But on the other hand, I think it's very important to recognize that there's $6 trillion sitting in money market mutual funds. It's been fairly satisfied, earning 5.25% on their money, people in those accounts. And I think if they start to perceive that interest rates really are coming down, then you may see more money going into the bond market and into the stock market, offsetting the contrarian perspective that too many bulls is bearish.
I want to ask you as well about the election and the sort of lack of reaction there has been in the markets, right? I mean, if you look at the front pages of most of the non-financial papers, they will be focused on what's going on with President Biden and the re-election campaign. Right. When do you think what would be a trigger for that to change, for the markets to start paying more attention?
Well, it's a great question. I don't really have the answer to it, but I have observed, I think we've all observed, and your question implies that the market has done remarkably well despite the political partisanship, besides all the turmoil we see going on in Washington. And I think investors, whether they're conservative or liberal, Democrats or Republicans, have learned over the years that you don't want to let politics determine your investment approach. So, for example, if you were a big fan of Obama, then you probably were long the market then. But if you weren't, you might not have been in the market at all and missed a very good bull market. Same thing happened with Trump and again with Biden. We've had very partisan White Houses where half the country liked the president, half didn't. And yet the stock market just keeps going up. And I think that speaks to the strength of the economy. It speaks to the fact that, Washington doesn't matter for everything going on in our economy. There's a lot of us working stiffs that are going into the office and to the factory or wherever every single day, working hard, trying to make things better. And on balance, we succeed and offset the meddling of Washington.
Ed, you raised your target on the market. I'm just curious which sectors you find attractive here, Ed. What are you telling clients?
Well, I haven't changed much in that score. I'm still talking about technology, financials, industrials, and even energy as a sort of a shock absorber in the event that there is a shock out of the Middle East or Russia, Ukraine that leads to higher oil prices. But generally speaking, growth is still where I want to be.
Ed, thank you so much. Appreciate it.
Thank you.
Let's get to some calls of the day now. Bank of America is raising its price target on Costco amid strength in same-store sales and its increase to membership fees. And it's part of a broad positive reaction to the company raising its membership fees. But as you can see here, the stock
at least on the
trading
street
down. Yeah, I mean, at least on the street. I mean, the stock is up a lot this year. So
this was what we were waiting for.
This
Boosted
is
membership fees.
Yeah, exactly. And you know, there have been some analysts as well that have looked into the history of how Costco then does after it raises its membership fees. And it tends to go up. We heard Corey Tarlow of Jefferies at the top of the show. He was on the morning show, but we heard a little bit of his commentary where he talked about that people don't leave Costco even when the fees go higher.
Oh, absolutely. My old man, it's the only place he's going for steaks.
Yeah?
Absolutely. Bank of America, by the way, they say the strong June comp and the announcement of this fee increase means they take their price objective, Julie, to $9.62, given they say continued comp strength and greater earnings visibility. So they're fans.
Yeah, but the stock going down.
Darden Restaurants hit with a downgrade from Jefferies, taking the stock from a hold to underperform rating, citing risk to fundamentals. So team at Jefferies, they do downgrade this one, the equivalent of a sell, target 124. Of course, the operator of Olive Garden chain, they talk about share loss in a more promotional environment. Julie, question whether these folks are going to be able to compete against more lucrative discounts and promotions elsewhere in the casual dining segment.
Yeah, and they're looking at full service in particular and says that more value-conscious consumers are weighing on any share gains for full service. So if you're looking at something like an Olive Garden, for example, or Chuy's, which is another stock that they got a little more cautious on, those are restaurants where you go, you sit down, somebody comes to your table, you order. They're also more expensive as a result of having that full service. And so this is one of the things he talks about. He says they could become increasingly dependent on traffic, and that the value companies within this restaurant universe will benefit in this type of environment.
Yeah, they say, listen, Darden does possess, they call it a robust portfolio of assets, but they say we see risk to more moderate growth in the near term that could continue to weigh on fundamentals and valuations. So they slap a sell on it.
Yes, they do. But the stock's not down.
No, not today.
But we'll see what happens. All right, monthly consumer prices dropping for the first time in 4 years. That's a welcome sign for investors hoping for interest rate cuts this year. We will discuss in more detail next.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
The latest CPI print, that's the Consumer Price Index for June, coming out today cooler than expected. And that slowdown could be what the Fed needs to start cutting rates. For more, we're bringing in Seth Carpenter, Chief Global Economist at Morgan Stanley. Good to see you, Seth.
Great to be here. Thanks
for
being
in. So the thinking now, at least the consensus, is coalescing around a cut in September and perhaps one more cut before the end of the year. Is that in line with how you guys are thinking of it? And was this that data point that the Fed needed?
This is definitely one of them, but it's good to remember, go back a month and we had another CPI print that surprised consensus to the downside as well. Our baseline is and has been for a while 3 cuts this year. And before last month's print, the amount of hate mail we would get was incredible. And I said, just wait for it. And then we got last month's print and people started coming around saying, you might be right, but boy, 2 is probably as far as it can go. We get today's print, and I think you'll see market pricing is actually creeping even further. So the market's pricing in a little bit more than 2 cuts for the rest of the year so far. We think they get there. Some of the communication from Fed officials today has been, I think, in the same direction. I thought Chair Powell's testimony this week was really important, where he said, we've seen some progress. He called the progress on inflation modest, but that was before today's data. But he also said, we have to pay attention to both types of risks. If we stay too high for too long, we put at risk employment. And so I think what today's print does both gives them that much extra confidence inflation's coming down. And if they do start to see any signs of weakness in the real side of the economy, they've got greater latitude in order to be able to react to that.
Let's talk about that labor market, Seth. I'm curious to get your take, because it is cooling. But when you look at the labor market, are you concerned?
Concerned, no, but I will say the job market report from last month, I've been telling people it's like a Rorschach test. Whatever was already in your mind, and you look at the print, you can see it there. So I look at the headline number, 200 or so. That's a pretty solid number. Definitely cooler than where we were 6 months ago, a year ago, 2 years ago for sure. But by all counts, 200 jobs per month is pretty good for the U.S. economy. The private number, which is probably giving you a better signal on where the actual market-based economy is going, was even softer than that, and it has been decelerating for the past couple of months. But if you sort of open the aperture a little bit and go back a year or two, you see that sort of has been going up and down. It's been trending down a bit, but it's not falling off of a cliff. So yes, we think there's slowing in the economy. Yes, the labor market is not as tight as it was before. But that's a good thing, and that's very much by design. That's what the hiking by the Federal Reserve was designed to do, was to put the brakes on just a little bit to the economy.
There's another area of the economy where there was a little relief in CPI today, and that was shelter costs. But you guys recently put out some research looking at housing in the U.S. that I thought was really interesting. And among other things, it pointed out the gap between people who have mortgages, who are in their homes already, and then, as we see there on the right side, the tick up in the actual mortgage rate if you're buying a home now. Unfortunately, Josh is keenly aware of this right now. So Seth, even if rates now start to come down, what's going to be the lag effect for the housing market? How long is it going to take that to really recover?
It's a great question, and so shameless plug to my colleague Jim Egan, who's our housing specialist, fantastic, and he and I spend lots of time talking about this. The first thing is we came to this from the inflation side of things, and it's really important to separate the current housing market, especially for things like new homes or existing home sales and things like that, from the inflation data. They're very, very separate. The inflation data come from quotes the BLS gets on actual rents. And so the fact that that part of inflation is coming down, and we think will continue to come down for the rest of the year, that's actually not much of a surprise, because we can look at the actual data on rents and it tells you very clearly where that inflation is going. The housing market, current housing activity, is driven by lots of things, mortgages especially, available supply. So what's likely to happen? We don't think, even with our forecast of the Fed cutting rates more than what's in the market, it's going to be enough to really move that, on the chart that you showed, the sort of average effective rate for people down to anything like where other people are right now. It'll bring things down for sure. Long-term interest rates can come down. It'll help with mortgages. But the majority of people who got 30-year fixed-rate mortgages back in 2021, 2022, they've got a mortgage that starts with a 2 or a 3. We're a long way away from that. So we think the housing market's going to move mostly sideways. Think about a bull case, a bear case. It's probably single digits, either up or down. And I don't think the cutting from the Fed that we expect to happen over the next, call it 6 months to a year, is really going to be enough to move that needle.
Let me ask you something. We got some earnings reports today. As you look through the reports, you listen to the CEOs, and they talked about the consumer. There were some reasons for caution. It had kind of a cautious tone to it. I'm just curious your take on the American consumer. Where are we, Seth? Where are we headed? Are you nervous?
Nervous. Not particularly nervous, but if you meet an economist who's not sort of on alert, then they're not doing their job. I think in the same way that I was talking about the job market, we're seeing cooling. I don't think anyone can argue with that. We're seeing some normalization. If you go back a year, 2 years, the consumer was on fire. The purchases in particular were heavily skewed towards goods. That's normalizing. And so if we look at the data so far this year, much weaker demand for consumer goods, but some of that is just payback of wallet share from the bad old days of the pandemic when people were going out much less and spending on goods. So there's definitely that slowing. We don't think we're going to fall off of a cliff. There's going to be some segmentation. The upper end of the income distribution absolutely still spending, especially spending there on services. And I think that's part of what's going to keep the economy chugging along, why we can slow without crashing. And so it'll be a fractured consumer. The bottom end of the distribution, you see delinquency rates drifting up a little bit. Their wage gains have slowed down compared to where we were a year ago. So definitely some slowing, definitely some spread in the distribution, but I don't think we're at the point where we're looking at the consumer just coming to a halt.
And you are, as we mentioned at the top, the global economist. So I always like to ask you a little something outside of the U.S. We've got NATO meetings going on right now, but there's been a lot of attention on Europe and the elections that just happened there. Are you thinking about any sort of economic repercussions from those elections? I mean, particularly in France, for example, where there's been a lot of talk that Emmanuel Macron won't have the economic mandate that he has had.
No, absolutely. And I have to say this year is a remarkable year from beginning to end in terms of elections all the way around the world. We had, India, really big economy with an important election and several others. For France, one of the places where the market's really been focusing is what happens with the fiscal situation. And sometimes you'll get fiscal situations where if you have a fractured government without a clear mandate, much less gets done and you can get fiscal consolidation. The risk, on the other hand, is to bring people together and to get anything done, you have to say yes to everyone. And so one of the places where initially, I think, after some of the preliminary elections, including for the European elections overall, the market started paying attention was, are we going to see some sort of fiscal loosening? And you saw it show up in oat spreads. Right now, we're at the place where we're waiting to see what sort of government gets formed, what the plans are, because I do think it will be very, very challenging for Macron not having sort of if he's not able to assemble enough of a coalition to really drive forward his own plan.
Yeah, we'll see.
All right, Seth, we're always lucky to have you on the show. Thank you for joining us. Appreciate it.
To be here.
Time now for To Watch, Friday, July 12th. Starting off on earnings. Earnings season is back with big banks on deck. Ahead of the open, JP Morgan, Wells Fargo, Citigroup analysts are keeping a close eye on net interest income for all three. And the banks will also provide more insight, of course, into the health of the consumer.
And we've got another inflation reading on tap. The producer price index is out ahead of the open. Economists forecasting overall PPI as well as core PPI will increase month over month in June. This coming after today's consumer price index came in cooler than expected.
And more on the economic data front. Consumer sentiment for July due at 10 a.m. Eastern. That number expected to tick up slightly to 68.5, giving us more insight again into the state of the consumer.
And finally, we'll be keeping an eye on reaction to President Biden's news conference tonight. He is planning to take questions at 6:30 p.m. Eastern. It coming as Biden wraps up the NATO summit in Washington, D.C., and will serve as another test for Biden to convince critics that he's capable of continuing his campaign for re-election. And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. June's cooler inflation print boosting odds of a September rate cut. Good news, right? But we're not seeing much green in today's markets. Investors are pocketing their gains after a record string of all-time highs, the S&P 500, and rotating out of those big tech winners, in the process snapping that winning streak. Plus, Tesla snaps its 11-day winning streak after a Bloomberg report that the EV maker's long-anticipated robotaxi event will be delayed to October. But our next guest reminds us delays often a part of the Tesla story. And encouraging, that's how Pfizer described an early-stage trial of its weight loss pill. If successful, the drug could be a golden ticket for Pfizer, which has thus far failed to successfully break into the rapidly growing GLP-1 market. We'll discuss more with a biotech expert later in the hour. Tesla stock has been on a tear. Its 11 consecutive winning sessions helped the EV maker regain all of its lost ground so far this year until today. Tesla's robotaxi event, one of the drivers behind that stock's recent run-up, has reportedly now been delayed by 2 months, sinking the stock back into negative territory for the year. Joining me now is Doug Clinton, Deepwater Asset Management Managing Partner. Doug, it is great to have you on the show. So let's dive right into this headline, Doug. So reportedly, maybe Elon Musk thinking of delaying this robotaxi event, Doug, to October. In your opinion, you know this company so well. Big deal? No deal? How do you see it, Doug?
Well, Josh, the first thing I would say is nothing is official in Tesla land until you hear it from Elon himself, because what sort of led to this event in the first place was a Reuters report several months ago that the Model 2 was going to be canceled. Elon said that that is false, and then he followed up saying that we're going to have a robotaxi event in August. We haven't seen Elon tweet anything yet. I just checked before we jumped on air here. He hasn't said anything about the event yet, so who knows what could happen. But let's say that the event is delayed, in fact, to October. In my view, what the stock has been doing more recently is it's been reflecting the hype and the excitement that investors are having for Tesla and what might come in terms of this robotaxi and what that ultimately might mean for the model. And Tesla, more than any other stock, is such a powerful religion. And I think that investors, as they see these new products coming, not just the robotaxi in October, but probably a few new vehicles as well, I think people are starting to figure out what could this mean to our models. And they were sort of front running potentially some changes in terms of how analysts and investors think about that business.
And Doug, when you talk about robotaxis, though, I mean, it's such a long-term goal in some sense, Doug. I mean, wouldn't it be a very long time before you would see any, real meaningful financial impact from that?
I do think that's probably realistic. And it's funny, I mean, going into the event, actually, given Tesla's track record, but also just what they do. I mean, they solve really hard physical, real-world problems. And they're maybe one of the best companies in the world at it, but often their timelines are a little bit optimistic. They often miss their timelines. It's just a normal thing with Tesla. Going into this event, I sort of assumed whatever date they put on their launch of the robotaxi, you might want to add 6 to 12 months to. And then if you think beyond that, to the point of your question, Josh, when does it actually start impacting the model? Tesla has a really large business already in terms of selling cars. They obviously have several 100,000 FSD subscribers as well. And so the robotaxi business would have to get to a pretty decent scale to really start having some impact, meaningful impact on the model. So I think we could still be in a situation where even if the robotaxi launches, let's say late next year or early in 26, the real impact to the model might still be a few years beyond that. Even investors will start to discount some of that into the model, but we will have to be patient before seeing real numbers in it.
I'm also, Doug, curious while I have you, just switch gears a little bit, get your take on XAI. I'm just curious, so this is Musk's AI startup. I'm just, as you think about that, Doug, that AI startup, what is Musk up to there? What do you think his objective is? What's he trying to achieve? He does have, he's got a lot of data at his disposal, Doug.
He does, and Deepwater, in full disclosure, is an investor actually in XAI. We're very
you are.
excited to be a part of that.
Doug, that's interesting. Why? Why did you invest?
We share the vision that I think that Elon has kind of proposed for what XAI is all about, which is sort of to be this maximally truth-seeking AI. And to be maximally truth-seeking, I think you have to really have a deep respect for figuring out, the sciences, figuring out physics. And if you think about who in the world has done the most to figure out things, physical problems like we just talked about, it's Tesla, it's SpaceX, and it's Elon. And so I think he's probably in a different and more unique position than some of these other companies like a Google, like an OpenAI, who are great in the digital space, but they're sort of amateurs in the physical space. I think that's where the real opportunity is for XAI.
And finally, Doug, I'm just interested to get your take on another big name, which, like Tesla, has had a nice run here, Apple. We're getting ready for Tim Cook to take the stage, Doug, in September. That's when you would expect him unveil that next iPhone. And bulls they're optimistic, Doug. They think, listen, this AI-enabled iPhone, it is going to jumpstart a meaningful upgrade cycle. Is that how you see it, Doug?
Apple's up 10% since that AI event in June. And I think the reality is this. We've seen some reports recently that Apple is potentially thinking about orders for the new device, the iPhone 16, about 10% higher than what they did last year with the 15. And just to put that into context, Apple has been sort of down mid-single digits year over year in terms of total revenue, which is largely reflective of the iPhone for the past several quarters. So if we go from down kind of mid-single digits to potentially up 10% year over year, I do think that that's probably a meaningful inflection for Apple. And I think it's probably higher than where the street is at in terms of numbers for the model. I think it's all about, can they deliver on the promise of making AI ultimately simplistic and usable for the average person? And again, they might be the only company or the best company in the world to pull that off.
Doug, always great to have you on the show. Thanks so much for taking the time to join us.
Thanks, Josh.
Yahoo Finance's Jared Blickery joins us now with more on the trading takeaways. Jared.
What a day. I'm going to show you. The Mag 7 just got a beat down. I'm going to show you how bad it was, and then we can have a conversation about what the future holds. Just to rattle off some statistics, and this is some of the largest stocks in the world. You're seeing Nvidia there down 5.5%. By the way, that was not the worst showing today. Some of the stats get pretty bad. For the Mag 7 overall, this was the worst day in a year. You'd have to go back to July of last year to find.
Look at all that red.
Look at all that red. Tesla snaps an 11-day winning streak. Worst day since January 25th, second worst day of the year. Apple snapping a 7-day streak, worst day since March 21st. Anyway, it goes on, and you can kind of see where this is going.
So the bull market's over. We throw in the towel. Last one out, they turn off the lights.
I'm going to go home right now.
That's it.
But let me show you what's happening.
That's not true.
It's not true. Okay. There's some green on the screen, not just Bitcoin. Look at Berkshire Hathaway up 1%. What is Berkshire? Okay, they own Apple as their biggest position, but that's a value firm. Look at ExxonMobil, energy in the green today. I'm going to show you something that gets me really optimistic here, and that is the Russell 2000.
That was such an interesting move today.
Let me just show you the day. This is what the Russell 2000 did. It gapped up and it just went higher on the day. 3.5% on a day when the Nasdaq 100 is negative by 2.24%. I ran the stats. The last time that we had the Nasdaq 100 under 2% and the the Russell 2000 over 3% happened one time in history, and it was November of 2020. And let me just show you a 5-year chart so you can see where that was. This is the Nasdaq 100. I want to show you the Russell 2000. Boom, it was right on there, right before liftoff. So this gets me to thinking, the Russell 2000 has been stuck in this sideways range for quite some time. Is this finally the catalyst, this friendly inflation report that it was needed to propel it to new heights? I'm going to argue that all of this rotation, and we're calling it rotation for a reason, people were overly invested in mega caps because they were scared. This is kind of a safety play, believe it or not, and they have sold and they are investing in the rest of the market. So
in other words, they booked a little profit, redeployed.
Yeah, I think it's a healthy move here. So I actually am bullish on small caps going forward just because of this one-day price action, subject to immediate reversal if I see something different happen. But that's the way it works. Modern tech now, this is a big picture statement, is greater than the dot-com era tech. We just had Ed Yardeni on the show. This is one of his charts. This goes back to the mid-90s. And this shows in purple, this is if you take the tech sector market capitalization plus communication services, so you want to get some of the telecom, well, you want to get Alphabet and Meta even there, even though they didn't exist back then. That's the way that he's constructing this. So you have the tech and the tech-ish down there. They surpassed 40% of the S&P 500's market cap. Right now it's at 42%. And so everybody says, all right, we saw what happened back in the dot-com. Is that going to happen today?
Yes. How does this end?
All right.
25 years ago, pretty bad.
Exactly. And what I do like about this is I look at forward earnings. So the forward earnings share as a percent of the S&P 500 for tech back then was only about 20%. Look where it is now. It's much higher. That's because earnings are supporting this higher move in the share prices of these tech stocks. I showed this chart a couple days ago. This is just S&P 500 earnings expectations. They are now at a record. And what you want to see is they have done nothing but increase since we saw this bull market began. Going back to this chart, that's what happened in here. So I think that the earnings, the gas in the tank, is enough to support a higher move.
All right, third, final, Jared Blickery takeaway.
This is cash on the sidelines. Hold on. Yeah, cash on the sidelines. This is at a record. More from Ed Yardeni. Yeah. This is $2 trillion for retail alone. Institutional plus retail is $6 trillion. Now, when the Fed starts lowering its rates, guess what happens to money market fund rates? They go down too, in lockstep, in real time. All that money, well, some of that money, could move off the sidelines like it's done many times before.
So rate cuts are always good, Jared?
You know, rate cuts are not always good.
That's not true. Okay.
The thing is, if you get a rate cut in response to this market-moving calamity where recession is finally getting priced in, that's another story. But that's not what we're dealing with right now.
All right, we'll save that for another takeaway.
Yes.
Jared, thank you. Killed it, as always.
Thank you.
Coming up, there's big money in GLP-1s, and Pfizer wants a piece of the weight loss drug pie. More asking for a trend on the other side. Killed it, killed it. Pfizer says it will proceed with the once-daily version of its weight loss pill, the company among the many drug makers racing to grab a portion of the weight loss market potential. This year alone, the U.S. weight loss market is expected to grow another 4.3%. That's according to market data. As interest in this space continues to rise, more eyes are set on how to get in on the action. Here to discuss ways to navigate the shifting biopharma sector, we have John Flavin, Portal Innovations founder and CEO, along of course, with Yahoo Finance's Julie Hyman. John, it is good to see you. So this GLP-1 fight, it only continues to seemingly heat up, John. And of course, we've been focused on big pharma. I'm curious, though, John, as a venture investor, are you seeing this trend, this theme that investors are so interested in? Is it also playing out, John, in the startup space?
Absolutely. You know, if you look at what's happened in the GLP-1 space, which, by the way, has taken several decades to play out, you know, dating way back to when GLP-1 was first cloned by Svetlana Matshov, you know, way back when, it's finally coming to fruition. And when we think about the stats in the market 40% of Americans today are obese. The expected global market for obesity drugs by 2030 is expected to grow to $100 billion. And so the stats are showing that there's a major market need. The science is moving in a direction that's opening up opportunities to actually make a market impact for these patients that, by the way, have comorbidities like diabetes and other heart issues. So we're seeing a pipeline of about 240 companies that are either developing or are moving toward the market with obesity or cardiometabolic drugs. We've got a partnership with Novo in place, and we've identified companies that we'd like to co-invest in that are all in that cardiometabolic arena. So one company we like a lot that we've invested in directly is Syntys. They're developing a next generation pill that's coming at a different pathway than GLP-1, but huge opportunity and a lot of capital going into that space.
A lot of capital going into that space, John. Is it coming at the expense of other areas, right? Certainly in the public markets, we've been talking a lot about GLP-1s. There's been huge investment in those publicly traded stocks. Is that happening in the private markets as well? And are other areas, other treatment areas, getting starved a little bit because of that?
No, I think, you've got to look at the dry powder that's been accumulating here in the past couple of years. Both at the big pharma level and at the VC level. So record levels of LP money going into biotech-directed venture funds, over $25 billion just last year into fresh powder. Just last week, Flagship announced Fund 8, $3.6 billion going into 25 startups. That'll be an array of companies that go well beyond obesity. Things that we see really getting a lot of focus and attention with dynamic science happening outside of the cardiometabolic space are neuro. We're seeing a lot of good companies in that space. And I think on the heels of the Eli Lilly news with regards to their Alzheimer's drug that got FDA approval, showing 30% reduction in cognitive failures for that class will be a gateway to many other companies that will focus in the neuro space. So companies like Vanqua, working on Parkinson's, venture-backed company here in Chicago, Nomura, Gate in Indianapolis, with a halo effect of what's happening coming out of Eli Lilly. And then lastly, a lot going on in autoimmune disease, especially in areas like lupus and also tech bio. You're seeing a lot of AI-focused and enabled science that I think will accelerate some of the work in these neurodrug programs.
John, another trend we talk about here on the show, you won't be surprised to hear, is the mega trend of AI. I am curious, John, how that technology is impacting and transforming your world, life sciences investing.
Yeah, well, first, from the aperture of the venture capitalists, we have developed our own tool called Stargaze, which is an AI-enabled platform that can predict innovation and start to rank innovative inventors coming out of universities. Remember, the lifeblood of a new drug starts on the bench at a university several years prior to it becoming a drug. And so we're using this tool to mine the universe to identify who's working on what hot area of technology, how do we get there first to make those investments. And using the machine learning algorithm, we can use predictive biomarkers to who might be a promising up-and-coming scientist working on the latest cutting-edge science anywhere in the world, but certainly here in the United States. Now, if you look at the applications in science, we've got a company here in Chicago, Tempus AI, that went public a few weeks back, precision medicine. So using AI for accelerating, figuring out what drugs are going to work with which patients in any kind of disease, ranging from cancer to cardiometabolic diseases. You've got other companies like Recursion Pharma out in Salt Lake City that's applying tech bio and AI to identifying drugs in both neuro and oncology. That space is heating up very quickly, and I think you're going to see strong benefits to what's happening in that regard. Lastly, really way out there in the future is quantum. So believe it or not, quantum is really starting to get applied to life sciences as well. So the ability to simulate the drug discovery process and take shortcuts and accelerate going from a petri dish all the way to a patient. I'm really excited about what will happen the next decade in that area as well.
A lot going on in a fast-moving industry. John, thank you so much for joining the show today and walking us through it.
My pleasure, Josh and Julie. Good to see you.
Stay tuned, more asking for a trend on the other side. Everyone is trying to grab a piece of the AI boom, but adoption among companies remains muted. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yes, and the chart of the day is a little busy. There's a lot going on. Do not be afraid. I'm going to walk you through it. But before I do, I'm going to tell you where this came from. It came from a new note out from Goldman Sachs, sort of a deep dive, including a couple of interviews into AI adoption and what investors can expect. And the overall theme of the note was that perhaps expectations have gotten a little bit ahead of themselves. One of the pieces of evidence that they cite is this data coming from Goldman Sachs and the Census Bureau, which talks about AI adoption. How many firms of all sizes, from small to the very largest, are using AI in their operations? And so one of the things I want to point out here, first of all, is that this number right here is 30% of firms. None of these industries have gotten to 30% of firms using AI as of yet. The one group that is using it the most, information, is right around 20%. 6 months from now, that's what this amber line goes out to, 6 months. The purple is from last October. June 2024, effectively where we are right now, is the blue. And then where we get to in the next 6 months is this sort of orange line. All industries, which is sort of in the middle here, isn't even at 10%. So the point is, for all of the talk about AI, for all of the companies investigating whether they are going to implement AI, there just aren't that many that are using it today, or even, according to this particular estimate, might be using it 6 months from now, Josh.
Carefully laid out there, Julie. Now, what is the counter argument to that?
Well, one of the people who brought us one counter argument was our friend Corey Johnson from the Futurum Group, who we talked to earlier today. And he said, maybe we're not framing it exactly correctly. This is what he said.
But I think that, and the Goldman Sachs note, again, it is very thought-provoking. But I think one of the fallacies that the negative criticism in the note has is that the things that we do now with our computing will be the things that we do later with AI-driven computing. And I think that that's just wrong. I think it's hard for us to imagine the things that we'll be doing with AI.
So in other words, again, maybe the framing is incorrect, that there will be use cases for AI that we're not contemplating right now, but I still don't necessarily think that the timing then is contradictory to what we have here. It's going to take a while to figure out what he's talking about.
All right, Julie, thank you so much. Appreciate it. And that is a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.